Hey everyone, and welcome to the Explainers. Today we are mastering the macro. Now, if you've spent any time looking at charts, you already know that technical analysis is fantastic for showing us exactly where the market might move. It gives us the lines, the zones, the historical patterns. But fundamental economic data, well, that dictates exactly why the market moves. And frankly, if you ignore the why, you are completely trading blind. I want you to picture this. It is exactly 8:29 a.m. on a Friday morning. The financial markets across the globe are completely paralyzed. The candles on your screen, frozen. Institutional banks, high-frequency algorithmic bots, and millions of retail traders worldwide are just staring at their monitors, holding their collective breath. Suddenly, the clock strikes 8:30. In a fraction of a single second, the S&P 500 shoots up 1%, or maybe it violently crashes by 1.5%. Millions of dollars of wealth are transferred before you can even blink. What just happened? I mean, did a major corporation suddenly go bankrupt? Did a global conflict break out? No. The government just released a simple piece of paper with a few numbers on it. And those reports? They completely shatter technical chart lines. Okay, let's dive into this. Here is our roadmap for building your fundamental compass out of the big three macroeconomic indicators. 1. CPI, the inflation scorecard. 2. NFP, the economic heartbeat. 3. FOMC, the puppet master. 4. Why good news is bad news. And 5. The pro trader playbook. All right, part 1, CPI, the scorecard for inflation. Let's kick things off with our first essential indicator, which is released right around the middle of every month at 8:30 a.m. Eastern Time. This is the ultimate measure of the true cost of living. CPI stands for the Consumer Price Index. The absolute easiest way to think about CPI is to imagine a massive shopping cart. Inside this cart, you place everything a typical household buys in a given month. We're talking groceries, rent, medical bills, fuel, even the cost of a haircut. Every single month, the government checks the total price of this exact same shopping cart to see if the cost of living is rising or falling. If the cart costs more this year than it did last year, well, that percentage difference is your inflation rate. Now, professionals make a really key distinction here. While the headline CPI tracks absolutely everything in that cart, Wall Street actually pays much closer attention to something called core CPI. Core CPI is the exact same shopping cart, but they take out food and energy. Why? Because the price of oil can spike wildly due to things like geopolitical conflicts, and food prices can swing just based on the weather. Core CPI strips out all that noisy volatility to reveal the true, sticky, underlying trend of inflation. Oh, and you also want to keep an eye on the PPI, the Producer Price Index. That measures what factories pay for materials. If their costs rise, they usually pass that right on to consumers, making PPI a massive leading indicator for next month's CPI. So, the crucial point is this golden inverse rule. How does this actually affect the charts you trade? If the CPI number comes in higher than expected, meaning inflation is running hot, it generally forces the central bank to raise interest rates to cool the economy down. Higher interest rates attract global investment, which massively strengthens the US dollar. And when the US dollar spikes, gold and the equity markets typically get crushed. It's basically a giant economic seesaw. Moving on to part 2, NFP, the economic heartbeat. Now we hit our next massive market mover. This is the undisputed heavyweight champion of volatility that drops on the first Friday of every single month. We're talking about NFP, or non-farm payrolls. NFP is the ultimate heartbeat monitor for the U.S. economy. It tells us exactly how many brand new jobs were created in the previous month. But there's a catch here. It specifically excludes farm workers, government employees, and nonprofits. By stripping those out, NFP gives us a pure, isolated look at the true strength and hiring power of the private sector. You might be wondering, why does Wall Street care so much about jobs? Well, it's pretty simple math. Consumer spending makes up roughly 70% of the entire United States gross domestic product. If people have secure jobs, they have paychecks. And if they have paychecks, they are buying iPhones, eating at restaurants, and paying their mortgages. A strong NFP report means a booming economy, which typically drives up the value of the US dollar and pushes gold down. But be careful, because here is a hidden detail that constantly traps amateur traders. Let's say the economy adds a massive number of jobs. Great, right? Well, if you look deeper into the report at average hourly earnings and see that wages jump by, say, 6% year over year, the market will actually panic. Why? Because if companies are paying their workers significantly more money, they have to raise the prices of their products to protect their profit margins. This triggers a terrifying wage price spiral, which essentially means out of control inflation. All right, part 3, FOMC, the puppet master. If CPI and NFP are the economic symptoms, we now need to meet the doctor that diagnoses them. Enter the FOMC, or the Federal Open Market Committee. This is a 12-member panel within the Federal Reserve that effectively acts as a puppet master. They set the gravity of the entire financial world. How do they do that? By controlling interest rates. Interest rates are just the cost of borrowing money, and they act as either absolute rocket fuel or crushing gravity for the stock market and global currencies. This committee meets 8 times a year, and they operate under what is called a dual mandate given to them by the U.S. government. Goal number 1, keep prices stable, which usually means targeting around a 2% inflation rate. Goal number 2, maximize employment. They are constantly trying to balance the exact data we just learned about, CPI and NFP, using the immense gravitational pull of interest rate hikes or cuts. When the FOMC finally releases their statement, traders are listening very closely for 2 specific tones. A hawkish tone means they want to raise rates to fight inflation. This makes borrowing expensive, cools down the economy, and is highly bullish for the US dollar. On the flip side, a dovish tone means they want to lower rates to boost a struggling economy. This makes money cheap and acts as rocket fuel for stocks and gold. And a quick warning here, the real market roller coaster usually hits about 30 minutes after the initial data release, right when the Fed chair steps up to the microphone for the press conference. One small comment there can change everything. Which brings us to part 4, market scenarios. Good news is bad news. And this brilliantly illustrates the most complex paradox in trading, the one that constantly confuses beginner traders who watch financial media. Have you ever watched the news, heard an anchor excitedly announce that the economy added way more jobs than anyone expected, and then looked at your screen only to see the stock market violently crashing? This is the good news is bad news paradox. Wall Street doesn't actually react to the job numbers themselves. They react to what they think the FOMC will do because of those numbers. If the economy is running way too hot, Wall Street is terrified the Fed will hike rates, making borrowing money just too expensive for companies to grow. Let's look at how this builds into 4 distinct market scenarios. First, you have the inflation shock, which is high CPI and high NFP. This is exactly what caused the brutal 2022 tech crash. The economy was too hot, so the Fed aggressively hiked rates, crushing stocks. Second, recession fear, driven by low CPI and negative NFP. Jobs are disappearing, corporate profits are collapsing, and investors panic sell to hoard cash. Third, stagflation with high CPI and low NFP. This is the absolute worst-case scenario. Prices are rising, but jobs are falling, and the Fed is completely trapped. And finally, the Goldilocks zone, featuring moderate CPI and steady NFP. Not too hot, not too cold, inflation is cooling down toward that 2% goal, but jobs are still steadily growing. This perfect combination is exactly what drove the massive late 2023 stock market rally to all-time highs. Finally, part 5, the pro trader playbook. So we know the reports, we know the major players, and we know the scenarios. Now, how do professional traders actually survive and capitalize on these massive data drops without completely wiping out their accounts? Well, you have to understand the exact moment a report drops. At 8:30 a.m., you are not trading against humans. You are trading against high-frequency algorithmic bots executing trades in milliseconds. This creates what we call the fake spike. The market might violently shoot up for 10 minutes, blowing out retail stop losses and widening spreads so drastically that true execution is nearly impossible. Then, as human analysts actually sit down and digest the real report, it violently reverses and trends the opposite way for the rest of the day. So here are the absolute golden rules for news trading. Rule number 1, do not try to predict the numbers. Unless you literally have a supercomputer in your basement, you are just gambling. Rule number 2, wait 15 to 30 minutes after the release for all that algorithmic dust to settle. Let the true fundamental direction establish itself first. Rule number 3, always look at the prior month revisions. Sometimes a headline number looks absolutely fantastic, but they quietly subtracted 100,000 jobs from the previous month without anyone noticing. And lastly, once that fundamental direction is clear, then you can use your technicals, like waiting for a 7 and 21 daily moving average crossover to find your perfect, safe entry point. By understanding the delicate dance between inflation, employment, and the Federal Reserve, you are no longer just a passenger on a roller coaster. You actually know how to read the tracks. So my question to you is this. Now that you hold the fundamental compass, how are you going to adjust your strategy for the next first Friday of the month? It is time to stop treating the market like a casino and start trading with absolute clarity. Thanks so much for joining me for this explainer. Stay sharp, manage your risk, and I'll see you next time.